Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. We had the front row seat for quite the wild ride yesterday after the USDA supply and demand report with the corn contract opening near the lows at 369 and then really rallying in a strong fashion for most of the day yesterday, but not quite able to get past the 388.5 resistance level. As we look at the market right now, we see that the resistance continued to hold fairly well, and as we're digesting the information, we'll continue to monitor these key levels to see which side the market's really able to penetrate first. At this time, we're still predisposed to believing that the market will continue down at least into our April 23rd timeline, but for now, we'll just simply monitor and see how the market continues to digest the recent information. Additionally, as we take a look at our natural box levels, we can see here that the two angles that came in really helped us to pinpoint the actual high and low for the move yesterday. And today we're looking at a potential inside bar, which is well shy of the point of control, or at least one standard deviation below the point of control of 389.25. Current prices are sitting right at about 378, and so really as we continue to track and monitor the market now, we have key support and resistance along these natural trend lines, and a break of either side today will probably lead to continued price action in that direction. The real lesson to be had today really is if we were fortunate enough to even cover or to at least hedge ourselves at some of the higher pricing from yesterday, that was a very good move. And what we want to do right now is make sure that we're positioning ourselves in the market in concert with the direction in which we believe that we will be most profitable. December corn is moving very nicely away from resistance. We saw our initial tag here at the 360 degree mark at 405 3/4. Upon hitting that number, the market then went down about 135 degrees, dropping down to test the 376 number. The market came in, bounced back up, found resistance again around 45 degrees, and has since been moving down again. So what we're looking at right now is going to be very important. The market needs to get above 395 3/4 if it is to move higher. We're predisposed to believing that the market is going to find very good resistance at these numbers or at these levels, and that we're probably looking for a retest of this 366.5 is probably more likely with regards to the direction that we're looking at. The point of control for the December contract sits at 391, key resistance yesterday. So even after the very strong move yesterday, we can see here how important that point of control is for the markets, and how the market actually opened today gapping down from yesterday's close and giving us this nice inside bar as it continues to digest yesterday's big move. Key level that we're looking at this week, or at least over the next couple of days, will be how the market looks to respond near that 391 number, as well as downside support at about 378 3/4. These two key levels this week are going to be very key to see how the market really has taken the information from the WASDE report. The soybean contract had been a bit tricky in its movement. We saw a nice consolidation pattern here that could have resolved itself in either direction. And so part of what we were looking at here was the initial break that we saw that broke back inside, but then we found another break on the downside that broke back into that movement itself. We had long contended that the 1043.75 and the 1028 levels were going to be very important for this market. And as we saw a break of either side, once the market was actually able to break in a strong fashion yesterday, it went straight to natural resistance, and this is where we see the market stalling here. Not too long ago, we suggested that about 1100 was going to be a very difficult area of demarcation for this contract to get through, and that appears to be the case right now, although it's not impossible. As we move into the rest of the week, we're starting to believe that we might see a small movement up to that 1100 number, and then as the week expires, to see a nice decline into the 23rd, with potentially one more advance back up again that can either get higher than our current highs or slightly lower. That remains to be seen, but upon that occurring, cycles are then pointing for end of month, or about mid-June rather, for the markets to kind of top and to give us a very nice decline into the summer months. Yesterday's move in soybeans was so strong that intraday it went limit up and backed off of those prices, and today we're seeing a bit of a pause as well. 2 standard deviations away from the point of control sits at 1069 and a quarter, which is actually very close to previous highs, and you can see the market just went straight through that area. We're now looking at overhead resistance coming in probably near that 1100 mark that we talked about not too long ago. And it's going to be very important for this market here, if it is to run higher in the short term, to at least show some strength above 1100. But we continue to find that 1100 is potentially a very good resistance at this time. Jumping over to the November contract, we'll notice here that our volatility bands are starting to point again to some very good resistance near the 1088 to 1104 number. That means that this market here potentially looks to find very good resistance as it gets up to this threshold, if it's even able to get up there. Upon reaching here, we will see a shift in our bands, and then the market will have volatility resistance that is pretty significant. Now, it also will coincide with our 207-degree mark of 1086 half. And so what that tells us is the market now is trying to build some confluence with overhead resistance. One of two things can occur then. If it's able to get through there, we're going to see some very good strength. And alternatively, if it's not able to get through, then we'll see a very good reversal on the way back down. Yesterday, with this big move that we saw, the funds were able to make quite a bit of money from that move, and so it would not be surprising to see the market start to lay off a bit with some profit taking with the move, because mind you, much of what has been occurring has been speculative and not necessarily fundamentally based. Having a look at our natural box, we'll see again that our market right here comes in and gives us some very good resistance near that 1100 mark. And so much of what we saw in the last chart is simply replicating itself here. July week continues to be very weak. We have now broken below the 465 and a quarter number, and it has now become very good resistance, and we see a bit of a distribution pattern occurring at the current price action over the past couple days. What we're looking at here then is a potential break of this market to replicate what it did on the other side, which means that we should see a potential move down to about 444 without any issue. We're touching up against volatility-based support here, but the next area on the band is very close to that 444 to 445 number, and that really is what we're expecting at this time, for the market to really make a nice decline as the narrative for wheat continues to be very bearish. Last week we discussed how the 487 to 482 number was going to be very important, and upon breaking that we saw a very nice move to the downside after breaking that 482 to 487 mark on this particular contract. In addition to that, we've highlighted a couple new levels for us to see. Minimum price objective that we're looking at right now is about 447. If the market's able to break through there and actually post a close below 433, we believe that the market will touch 416 at a minimum, but that key level that we're looking at is that 433. And so our first minimum price objective again is 447. If it's able to get through there and actually close below 443, we anticipate 416 at a minimum for this move. And so really it's not looking very good for wheat if it does find weakness in the near term. You'll notice how he's tracing along this natural angle here. So as long as he continues to move down this angle, he'll need to pick up off of one of these angles if he's able to bounce, but then again, because of the narrative, it's unlikely. In closing, we'll have a view at the crude oil movement that we saw. We have that wave 5 that we had marked off as a confirmed wave 5, and the market really consolidated after hitting that high for the last 5 to 7 trading days. After about day 7, it made a pretty nice low here, and over the last 2 days, the market seems to have been able to find a bit of strength here. It's up against resistance here, but given the nature of the move the last 2 days, we could see a shift of that wave 5 coming over and then posting another high here, or the market could potentially find some legs inside of here. This consolidation that we saw over the last 7 trading days does constitute good pullback off of that high, but it looks like crude may have a little bit more strength than anticipated here. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.